Are you thinking of growing your money without having to do so much work? Or perhaps you want to have a more promising investment portfolio by earning more returns? Well, lucky for you, you can do both through a simple investment. In particular, we're talking about investing in index funds. Index funds are ultimately easier to invest in, and they're definitely effective. All you have to do is invest consistently and have a little patience as you watch your money grow. Pretty cool, right? But how exactly does it work? And why index funds out of all investments? We'll explain more in today's video, so make sure to stick around to the end. Hey, welcome to Stock Market Mate. Today we'll talk about how to make money through index funds. Before we get into it, subscribe to the channel and hit the notification bell to help us beat the YouTube algorithm. If you're done with that, then let's get right into it. What you need to know about index funds. If you haven't heard already, index funds are a mutual fund or an exchange-traded fund which tracks performances from underlying benchmark index. Basically, index funds allow you to purchase and own stocks from different companies without having to choose and invest in individual ones. This ultimately saves you the trouble of having to research and analyze individual stocks, which inherently takes a lot of work. Index funds can be a great way to lessen the amount of research you have to do, as well as increase your money consistently. They also pose less risks compared to other investments. Investing in index funds is often called indexing, which means to invest passively or passive investing. On top of that, index funds provide investors access to a broad range of diversified investment opportunities, and they are usually cheaper than actively managed funds. Among the market indexes that index funds may seek to track are the S&P 500 Index, the Russell 2000 Index, and the Wilshire 5000 Total Market Index. Since they're diversified, index funds are less risky than individual stocks. This doesn't mean they're completely safe, however, but the index will likely fluctuate less than the individual stocks. How index funds work. Index funds are passively managed. They buy and hold securities included in the index. Investors can thus purchase a large sector of the market using just one fund, which is already very convenient. What's more though is that, owing to the low number of trades and the fact that no securities research and analysis is necessary, index funds are extremely cost-effective, meaning it is cheaper, which adds to the reasons why they're easier to invest in. Moreover, low costs make the index fund able to track the benchmark index closely. A major advantage of index funds is their superior performance when compared to other types of funds. Another thing is that index funds generate less taxable income since they trade in and out of securities less frequently than actively managed funds. Although there are a few drawbacks to them, such as they have no downside protection, they lack professional portfolio management, etc. However, judging by their pros, we can safely say that they weigh more than just a few of their cons, which is why they're definitely worth considering. How to invest in index funds. So now that you know some of the important information about index funds, let's now proceed to the next topic, which is how to invest in them and earn a hefty amount of return. Here are 3 steps you need to do, which we'll also be breaking down for you to remember. Choose an index. There are a great number of indexes you can track by investing in index funds. Among the most popular indexes is the S&P 500 Index, which includes 500 of the most prominent companies on the US stock market. There's also the MSCI Emerging Markets, which are more on international stocks. Apart from these broad indexes, you can find sector indexes, which target specific industries, country indexes, which target stocks in individual nations, style indexes, which emphasize fast-growing companies and valued stocks, and other indexes that set their own investment criteria. You can choose an index according to your personal investment goals and preference. Selecting the right fund for your index. After choosing an index, you can now choose an index fund that tracks it. Many popular indexes, such as the S&P 500, are tracked by a dozen or more funds. You'll want to ask some basic questions if you have more than one index fund available for your chosen index. These questions include, which index fund closely mirrors the index's performance? Which index fund has lower fees than others? As well as what limitations or restrictions apply to the index funds that prevent investors from investing. Buy shares. Every index fund has a ticker symbol, whether it is a mutual fund or an ETF. In buying shares, you need to take note of their symbols. Furthermore, if you're interested in buying or selling index funds, you can open a brokerage account. The mutual fund company that offers the fund may also allow you to open an account directly with them. It's important to consider costs and features when deciding how to buy shares of your index fund. Although in some cases, brokers charge their customers extra for the ability to purchase index fund shares, causing opening an account directly with the index fund company to be more affordable. So keep that in mind as well. Why invest in index funds? So why index funds? I'm sure we've answered that question along the way as we discussed some of the basics about index funds as well as how it works. They are among the simplest and most effective ways for investors to accumulate wealth. Index funds simply mimic the impressive performance of the financial markets over time, turning your money into a larger amount, and you don't need to become an expert to be able to pull it off. So there's that. There are also many other reasons why investors prefer index funds to others, such as that you can invest without worrying much about risks as there's not much risk to worry about in the first place. Many indexes include dozens or even hundreds of stocks and other investments that diversify your portfolio and reduce your risk of experiencing big losses should one or two companies in the index suffer a major loss. Another reason is that it makes it easier for you to stay on track. Another great advantage of index funds is that you can invest automatically month after month, regardless of market ups and downs, knowing that you'll be sharing in long-term market growth. Last but not least, index funds are available for many different types of investments. It is possible to buy stock index funds and bond index funds, which cover the two major areas of most investors' investment strategies. You can also buy index funds that specialize in certain segments of the market. Other things to keep in mind. Since index funds are simple to use, offer instant diversification, and generally provide better returns than actively managed accounts, they have become one of the most popular investment options for Americans. With that in mind, many will probably invest without giving as much thought to it. Don't take things at face value and always remember to do more research. So here are some additional aspects that you also need to consider. Is the index fund doing a good job? Your index fund should closely correspond to its underlying index. Hence, it's important to look if it's doing a good job at that. You can check this through the mutual fund quote page by looking at the index fund's returns. Is the index fund too expensive? Look for exchange-traded funds that track the index and that are worth its price. All in all, these are things you need to know on how to invest in an index fund and build your wealth without having to worry much about the risks in analyzing stocks to buy for your investment portfolio. Index funds got all that covered, and you just need to sit back and watch as your money grows into huge sums. Of course, you do still have to be consistent with your investment. With index funds, it's guaranteed to be successful at making you a great portfolio as well as generating great amounts of profits. Although it has its disadvantages, the benefits it has usually outweigh these, so you don't need to be afraid of them. Well, that's about it for today. If you found this video helpful, kindly like and subscribe, and don't forget to click that bell button to get notified whenever we post a new video. Also, you might want to leave a comment below and share your thoughts. We love hearing from you. Thank you for watching, and we'll see you in the next video. If you enjoyed this video, you're going to want to watch one of these two videos right here. Enjoy!